Let me tell you something that makes zero logical sense. There was an active war. Oil supplies were being choked off. Economists were throwing around words like depressionary. And somewhere in the middle of all that chaos, the stock market ripped to all-time highs. The S&P jumped 2.5%. The Nasdaq nearly 3%. The Dow had its single best day in close to a year. And every financial news channel on the planet ran the same headline: Relief Rally. Markets celebrate peace. There's just one problem. There was no peace. So, either the market is completely disconnected from reality, or the story you were told was just plain wrong. This video is about what actually happened. And once you understand the real mechanics behind that rally, you'll never look at a market headline the same way again. Here's what we're covering: why hedge funds were in full panic mode before any ceasefire was announced, how a short squeeze works, and why it became the real engine of this rally. The $86 billion of forced buying that almost nobody reported on. And why this exact same pattern keeps playing out over and over again. To understand what happened in April, you need to rewind a few months. Because going into 2026, Wall Street was already nervous. The AI trade was stretched. Valuations were high. And then in late February, the situation in the Middle East escalated fast. The Strait of Hormuz, one of the most critical oil choke points on the planet, was effectively shut down. Now, about 20% of the world's oil supply moves through that strait every single day. Close it, and you don't just spike oil prices. You start pulling on threads that run through the entire global economy. And the market noticed. By the end of March, the S&P was down nearly 9%. That's not a dip. That's a real drawdown. And while your retirement account was quietly bleeding, something much bigger was happening behind the scenes on Wall Street. Goldman Sachs runs what's called a prime brokerage desk. Think of it as the back office that services most of the major hedge funds in the world. Goldman sees what these funds are buying, what they're selling, and exactly how much risk they're carrying. And what Goldman was seeing in Q1 was alarming. Hedge fund selling in North America was the largest since April 2020. Gross leverage across the industry was sitting above 300%, near all-time highs. And short exposure to major ETFs like SPY and hit levels not seen since the pandemic. Translation? Every major player on Wall Street was betting the market would keep falling. Short positions were stacked. Bearish bets were piling up. The entire professional investing community had essentially said, "We think this gets worse before it gets better." And then, on the evening of April 7th, a ceasefire was announced. Here's where it gets interesting. When you short a stock, you're borrowing shares and selling them. You're betting the price falls so you can buy them back cheaper later, return them, and pocket the difference. But if the price goes up, instead you're stuck. You still owe those shares back. So now you have to buy them back at a higher price than you sold them for. And the longer you wait, the worse it gets. At some point, your broker sends you a margin call. You either add more cash or you close the position immediately. And when thousands of traders all get margin calls at the same time, they all rush to buy back their shorts simultaneously. That buying pushes prices higher, which triggers more margin calls, which triggers more buying. That's a short squeeze. And on April 8th, with short exposure near the highest levels in years, the squeeze began. But that was only the first domino. Once the squeeze started, the algorithms kicked in. There's a category of trading firms called CTAs, commodity trading advisors. These are systematic, rules-based funds. They don't read the news. They don't have opinions on geopolitics. They just follow price trends mechanically. Trend going down? Their models say, go short. Trend reversing up? Their models say, flip to long. Goldman estimated these CTA firms were sitting on roughly $30 billion in net short positions heading into that week. But the moment the S&P crossed certain price levels, their models didn't just reduce those shorts, they flipped entirely to long. The original estimate was about $40 billion of forced buying to unwind those positions. The actual number ended up being $86 billion across just 5 trading sessions. Goldman called it one of the fastest buying events in their recorded history. And there was still a third layer. In the options market, dealers who sell options have to stay what's called delta neutral. They constantly hedge their exposure. When traders pile into call options, dealers are forced to buy the underlying stock to balance their books. And when the market is already moving up, that dealer hedging adds fuel to the fire. So what you had was a short squeeze, triggering systematic CTA buying, triggering options dealer hedging, all stacking on top of each other in real time. 3 dominoes. One after another. That's the rally.
Not peace.
Not relief. A mechanical chain reaction built entirely on the structure of modern markets. And here's the thing, this isn't new. December 2018. Markets had been crashing for months on rate hike fears. Jerome Powell says one word, patient, and the Dow records its biggest single-day point gain ever at that time. August 2024. The Bank of Japan hikes rates. The yen carry trade unwinds. The Nikkei drops 12% in a day, then bounces 10% the next. Different events. Same machinery underneath. Because the modern market isn't really driven by humans analyzing companies anymore. Over 60% of U.S. stock funds are now passive index funds. They don't read earnings reports. They just follow the index automatically every day. What's left of active investing has consolidated into a handful of giant multi-strategy hedge funds running at 4 to 8 times leverage, with strict drawdown rules. When they hit a loss limit, they don't debate. They sell. And underneath all of it is an options market where same-day expiration contracts now make up the majority of S&P trading, forcing dealers to hedge in real time, constantly, at scale. The dominant players aren't analyzing value anymore. They're reacting to price. And when price moves, their reactions stack. So the next time you see a massive market move and financial media hands you a clean, simple narrative to explain it, pause. Because the headlines are almost never the real story. The real story is usually buried in prime brokerage data, CTA positioning reports, and options dealer gamma exposure. The stuff that doesn't make it onto the evening news. That's what this channel is about. If you want the actual mechanics behind what moves markets, not the dumbed-down version,
subscribe.
Because this is the stuff traditional financial media conveniently skips over. See you in the next one.